Welcome to my discussion on Accounting 2310. My goal today is to review the adjusting journal entries that are required for deferred items, both prepaid expenses and unearned revenues. I also have another goal. That other goal is to learn or to review how we originally learned recording and adjusting these accounts, and then the alternative approach. Let's get started, and let's start with prepaid expenses. All right then, are you ready? Let's assume that we made an expenditure, and in this expenditure we purchased $1,000 of supplies for cash. How would the original entry be journalized for this, both under our original method and our alternative method? So we'll look at the journal entry when this was journalized originally, when it was purchased. Under the original method that we learned in 1110, and then the alternative method we just learned in 2310. So what I would like you to do is to record purchasing $1,000 worth of supplies for cash under the original method and then under the alternative. Please put this on pause and make your entry. Welcome back. Under the original way we learned it, we would debit the asset supplies for $1,000 and credit cash for $1,000, setting up the asset supplies on our balance sheet. Under our alternative method, we would have debited supplies expense and immediately expensed all of it, putting all of it on the income statement. Neither one of these entries is right or wrong. They are simply entries. They do, however, change how we make the adjusting entry. Let's explore that next. Our adjusting entry is going to be made assuming $400 remain on hand. The entry will depend, the adjusting entry will depend on how you recorded or journalized it originally. Did you do it under the original fashion, or did you do it under the alternative fashion? I like to start by making T accounts because it helps me see where I'm going. So I'm going to look at my original entry first. I am going to set up supplies, which you can see I debited for $1,000, and then I'm going to adjust that into supplies expense. So if I have $1,000 of supplies that I purchased and I have $400 remaining on hand, there's a picture of that. I need to move some out of supplies and into supplies expense. And since they're all sitting in the supply account, I am going to have to adjust that account as well. My picture tells me supplies have a balance of $400 according to the data. What is the journal entry that will make the supplies account have a balance of $400? Well, you can see right away that I need to credit supplies for $600 and debit supplies expense for $600. So I'll make that entry, and then I'll note where my account balances are. I have supplies on hand of $400. That is correct according to my information. And supplies expense for the period is $600. So if you make your original entry into the asset account, this then is the adjusting entry. Let's look at the alternative approach now. And again, we have the same two accounts. We'll be looking at supplies, and that contra account is supplies expense. Spelled that wrong. Now I'm going to post my original or my alternative entry I made when I journalized it. To start with, I put the $1,000 in supplies expense. That is not good or bad. That is just what I did. According to my information, I have $400 remaining on hand. So to make a picture of that, I need to have $400 in the supplies account remaining on hand. What is the journal entry that will make supplies have $400 in it? And you can see by looking at it right away that I need to debit supplies for $400 to make that account have that balance. That means I will credit supplies expense for $400 because I need to have another side to that journal entry. Let's total supplies expense. You started with 1,000, you moved 400 to the asset. Where did we end up? We have $400 supplies on hand and $600 supplies expense. Notice, my journal entry did that for me. Although the adjusting entries are different because the amount originally journalized went to a different account, the account balances end up in the same place. I have $400 worth of supplies on hand and $600 worth of supplies expense either way. You have learned how to do them in a way I call the original method. There is an alternative method, and one is not better than the other. They do, however, create different journal entries. So, that handles expenditures, prepaid expenses. Let's turn the page and go to unearned revenues. In my unearned revenues example, I'm going to assume I have received $10,000 in advance for services I have yet to perform. So this was received in advance of performing any services. We will make the original journal entry when it was journalized, and there are two different methods: our original method and our alternative method. When you first learned this back in Accounting 1110, you knew that you received cash of $10,000 and you put it in an unearned revenue account in the amount of $10,000, and that was the original way we learned it. Alternatively, you could have received the cash, because you received the cash either way, and put it in a revenue account. So one method put it on the balance sheet as a liability, and the other method put it on the income statement as revenue. Neither of these methods are right or wrong, and they both will require an adjusting entry. They just are the way we recorded it. So now, let's assume for our problem that you have earned, as of the end of the period, $7,500 of this amount. What is the adjusting entry? So I want to make adjusting entries both under the original method and the alternative method with you. And let's start with the original, and let's use some T accounts to see where we are. We have unearned revenue from our original entry that needs to be moved into revenue. So I'm going to post this unearned amount, $10,000, into my unearned account, and then I'm going to say our adjusting entry should show that $7,500 of this has been earned. So I have told you that $7,500 has been earned. When you look at this, can you tell me what entry will make this work? And right away you should say, well, I need to take out of unearned revenue $7,500 and put in revenue $7,500 to make this work. And so when I put $7,500 out of unearned revenue and $7,500 into earned revenue, it does what I want it to do. Here's my journal entry, debit unearned, credit revenue. Let's see where the unearned account remains. It says we have $2,500 that remains in the unearned account, and that would make sense if we earned $7,500. And in revenue, I also have $7,500, and that's correct. The amount I have earned. So this is the journal entry for the original method, and it leaves both accounts in the right place. Let's look at the alternative method now and make T accounts that show where we are and then where we need to be. I have an unearned account that has nothing in it, and I have a revenue account that has $10,000 in it, based on this journal entry being posted. And remember, I have earned $7,500. So I want my revenue account to show that I have earned $7,500. What is the journal entry that will make my revenue account show that I have earned $7,500, not $10,000, which is where it currently sits? Well, I need to debit revenue for $2,500 to drop it down to $7,500, and that must mean I need to set up the unearned revenue in the same amount. So let's go ahead and post that entry and see if it works. Debit revenue and credit unearned revenue. That leaves me with $2,500 in my unearned account and takes my $10,000 down to $7,500 in my earned account. This is the adjusting entry if I've used the alternative approach. Once again, notice I end up with the same balances. I have $2,500 in my unearned revenue account and $7,500 in my earned revenue account either way. So it doesn't matter which method you used. You just need to make the correct adjusting entry. I highly recommend that you make T accounts and post your original entry. Post your journal entry when you originally purchased or received the cash, and then look at what balance you want in the account. And then make the journal entry that makes it happen. The adjusting journal entry. So you make a T account, you post the original entry, you show what balance you want, either in the revenue account or in the unearned account, and make the adjusting entry to make it happen. That's a good review of the original and alternative methods we've used for accounting for deferred items. Thank you for joining me. See you soon.